Welcome to ForexTV.com. Today is Wednesday, February 4th. I'm Tim Kelly with your New York Forex Market Buzz. Euro's falling against the dollar and the yen right now, but first a look at the headlines from the CEP News Desk. President Barack Obama announced today that executives of firms accessing extraordinary facilities from the U.S. government will have their annual salaries capped at $500,000 per year. The president said the view that the taxpayers were subsidizing salaries of executives was sapping market confidence. According to a G7 source, the G7 is likely to continue to put pressure on China to allow more flexibility in its foreign exchange policy. On January 22nd, the G7 source told Reuters that G7 members were also looking to directly address the depreciation of pound sterling in their statement following the February meeting. The services sector in the U.S. improved in January despite expectations for a continued slowdown. The ISM non-manufacturing index moved up to 42.9 in January, an improvement from the 40.1 level recorded in December. This marks the second monthly improvement since August. Today we're joined by Stephen Leahy of Back Bay FX. Hi, Stephen. Thanks for joining us today.
Hi, Tim. Thanks for having me on. As always, it's a pleasure to speak with you guys.
Yeah, it's been a while since we've spoken, so welcome to the show.
Thanks so much.
Steve, we talked a little bit about what might be happening in the days ahead with the BOE announcement, widely expected to cut by 50 basis points. The ECB announcement tomorrow, no one expecting any changes there, but looking forward to the statement. And, of course, Friday's non-farm payroll. Why don't you give us your thoughts on what we can expect one way or another for the majors or for any other pairs that you might be following?
Sure, certainly, Tim. You hit on the kind of key aspect of the next couple of days here. Bank of England and ECB coming out clearly. So the play that's getting a lot of attention on that in terms of currency pairs is actually euro versus sterling. Traditionally, always had, up until, say, 12 months ago, euro sterling had been a fairly tame pair, didn't move around that lot, didn't move around that much. Lately, in the last, I'm going to say 6 months, it's really been a intraday, very volatile currency pair, a lot of action, a lot of interest, and a lot of intrigue in it. So that being said, as you mentioned, it does look like the expectations are for the UK to cut rates and euro to hold steady, which you would think would cause euro sterling to move much higher. We tested back in late December. We tested going at the parity level between euro and sterling. Since then, it's fallen off dramatically, and even in the last couple of days here, euro sterling's fallen off from a level of about 92.50 or so to where we're trading at the moment is about 88.90, let's say. So it seems to me like this is a bit of a kind of what I would call a wipeout trade by a lot of the bigger firms out there. They're trying to clear out the riffraff, clear out the chaff. Anyone who had been long this pair on some fundamental basis gets a little scared out, maybe closes their long positions here, opens up the way for the announcements tomorrow morning to clear a path to a move higher in euro sterling. That gets a little bit into kind of the thoughts of how things work on a large-scale dealing desk, but kind of a brief summary of that is, looks like this move much lower in euro sterling over the last 4 days has kind of cleared out some of the undergrowth here, and it's going to allow for a move higher in euro sterling in coming days. The other thing that obviously this focuses on, the currency pair that we see most often paired up with euro and with sterling is the dollar. Once again, you and I are speaking off air. We've got a view on a technical basis going forward, a little bit longer term, that euro dollar has been basing around here, seem to have found a bit of a base in that 127 range or so, and so we're going to be biased going forwards on the long side. We do still tend to be fairly short-term traders here. We're in and out multiple times per day, but we always have a bias in our underlying fundamentals. And for us, once again, from a technical standpoint, it seems like we've put in a base here, and we're going to be looking to get long euro dollars.
Steve, you mentioned the wild swings we've been seeing, and really since the past month and even before, we see a lot of volatility. Do you think there's maybe a lack of liquidity in the markets causing these swings? I mean, they're fairly unprecedented when you go back a little bit longer on the time horizon, but we see, common to have 300-400 basis point swings nowadays. Is that just a liquidity issue, do you think?
I would agree with you. And I'll go one further if I may, Tim. I've only been doing FX since 1996, so it's really only been 12, 13 years here. There are people who are much longer in the tooth than I, but you are correct. The daily volatility that we've seen in the FX market over the last 12 months, specifically since September when Lehman went down, really has been unprecedented as far as I can tell, and even just looking at some charts from what I've seen. And so I do think a big cause of that is a lack of liquidity, not by end users, meaning retail clients, which I'll get to in a minute, but more from the big banks. You got to remember, Lehman Brothers and AIG were both really large-scale clearing banks of last resorts for the interbank dealers. And so with those two firms not adding any liquidity to the market, for the real big players, it's tougher to lay off your big positions. When you're Goldman Sachs, when you are Deutsche Bank, something like that, and you need to clear out 1-2 billion euros at a clip, you used to be able to call up Lehman or AIG and get a quote on that. Now you have to piecemeal that out to some other firms to kind of hide your positions, and it's a lot tougher. So there's a lot of less liquidity on the big picture side. I did mention the retail side of things. There's actually more and more activity on the retail side. I'm sure you've seen the numbers. Most of our clients out there are aware. The retail FX trading activity is increasing markedly. So you've got two different factors, two different demographics affecting the intraday volatility. One, there's more and more smaller players in and out of the market on a intraday basis. And two, there's less and less firms that are willing to hold on to larger positions in terms of the big aggregating firms or clearing firms. And so really that's what's causing this volatility on an intraday basis. And you're right, these 300-400 point swings over the course of a day that may even just get you back to ground zero from where you started, really a wild ride, and makes all of our jobs interesting.
Hey, Steve, let me. I'm going to try to get some perspective from you on this retail trading issue, and I try to do it quickly because it's a larger issue. But back in the 60s and 70s, institutions accounted for the majority of trades in the equities markets. By the 90s and the advent of online trading, that had reversed, and individuals were a larger part. Also, 401ks contributed to that, and other savings programs. But the individuals then became the larger volume players in the marketplace. Is that going to happen in FX? And if so, when does that happen?
Will we ever kind of break the fulcrum there of where retail individual traders make up more than the institutions? I think we've got a long ways to go on that. The institutions really is a massive side of things, and you often count the forwards and swaps on the institutional side. But that being said, the retail marketplace is expanding rapidly, whereas the institutional and corporate side is kind of, I don't know that they are not expanding, but they're certainly not expanding as rapidly as retail. So there's more and more there's more and more retail flow coming in the market. You see it, a lot of large banks are starting to offer, or at least looking into offering, retail-oriented FX products. And so I do think we'll see that continue. And the bigger picture is, like most asset classes that end up in all of our 401ks and individual portfolios, FX really now is its own asset class unto itself. It used to be mutual funds, options, and warrants, and futures, derivatives. Those are only for institutional investors, yet all of us probably have a piece of that somewhere in our 401k. I'm fairly confident that 5, 6, 7, 8 years from now, all of us will have some form of FX into our individual portfolios. A question of how and where, whether we trade it individually, whether it's done through a managed program, who knows. But it's very clear to me, demographically speaking, the retail side of FX is making up a much more significant part of the whole industry.
Sure. So I think we're going to be discussing that, you and I, perhaps going forward. One last question. You folks at Back Bay FX, I think you said before you're in the longer term long bias euro. Is that correct?
That's correct.
What do you base that on?
Really, I can say fundamentals, but fundamentals really, to me, are a very long-term, very, very long-term reason. To us, we're really kind of switched our view just in the last 2 or 3 days to a long bias on euro from a technical factor. We're looking at some charts that we use, some of the indicators that we use in terms of client flows and retail trading flows. It seems to us that euro dollar really has made a kind of bottom here and tested the 127 level a couple times. It's really bounced around between, let's call it 129.50 and 127 for, 2 weeks now. Seems like it can't break down below there. And so, again, that to us is a turning point. And so we'll look to get long here. And, again, not going to buy it here and hold on to it forever, but our bias going forward is to look for long buying opportunities rather than selling opportunities.
Quickly in the close, what's the time horizon on that long bias, and what's your target?
I think that we're probably going to head back up towards the level that we tested in mid-December on euro. If you remember, kind of on a one-day intraday spike, we got up to the 147 level. I wouldn't be surprised for us, again, just like it took about 6 weeks to go from that 147 level on an intraday basis down to 127. I'd spend the next 6 weeks. We're talking, the month of February and half of March. We're looking to get back and test above that 143, 144 level over the next 6 weeks.
Appreciate you giving us your insights, Stephen.
As always, thank you for the time, for being on your show.
Appreciate you joining us. This has been your New York Forex Market Buzz with Stephen Leahy of Back Bay FX.